We have seen, of course, the ascent of the 10-year yield. This GTV chart on the Bloomberg showing us what the 5-day gains look like, but they're not really that uncommon. This has happened several times in the past. I guess markets are a little bit unsettled given the speed of the move higher. Do you take a chance this time around to add to some positions given the bond sell-off, or do you just stay out?
Well, we think it's possible that in the very near term, you have a bit of volatility in long-term yields. So the market could easily test 1.6, 1.7 levels in the next few weeks, especially because we're dealing with a few supply-side shocks. And of course, this is happening in the aftermath of a relatively hawkish guidance from the Fed. So in the very near term, we're focusing more on short duration opportunities, but it just happens that the high yield segment in Asia credit has just gone through a pretty significant sell-off because of Evergrande. So there's a lot of value there, and obviously the duration is much lower. So what we're doing in our portfolios is actually reducing equity sensitivity in favor of select exposures to Asia credit, which is mostly shorter in duration, and this is what we're doing on our side.
You mentioned Evergrande, but of course that's really raising the uncertainty everywhere, right? What do you think are the implications of all of these payments that we have no idea if Evergrande is making right now?
Well, there will be some back and forth in the news flows about the company's ability to meet the obligations in the next few weeks, and the coupons keep coming up, and we're in that 30-day grace period. But we think the restructuring of the company is an inevitability at this juncture, given its fundamental fragility and heavy dependence on short-term funding. So now the good news is that the government has a pretty strong political incentive to intervene to make sure that the homes are delivered to the home buyers. So we think the financial aspect, it's not a systemic risk in the financial sense. But still, we have some uncertainties for the macroeconomic fallout of this move, because it's definitely affecting the real estate sector. That's pretty significant for the Chinese economy that's already suffering from slowdown. So we think there will be a policy intervention from the Chinese government going forward to limit the impact. Unfortunately, we have another wrinkle here, which is the power crunch that's happening. That could potentially become a bigger impact, a bigger issue for the market. But yeah.
Well, that's what I was going to get to. How much of an impact does that have when it comes to a huge supply side shock, right? And how do policymakers address that?
So this is a very tricky challenge, and it represents a bit of setback to our scenario, because for the fourth quarter we were counting on that pretty strong rebound from basically stagnation in the third quarter. Now we're coping with this increasing restrictions on power usage in key manufacturing hubs, and our base case is that by the end of October there will be a plan to address this situation. And the different provinces, compliance with the Beijing's restrictions on carbon emissions. But if this lasts for the entire quarter, then it can easily lob off 1 to 1.5% year on year for the fourth quarter growth. And that will be from 6.5% growth that we were expecting initially. So this is a risk that we need to cope with. It's slightly more difficult because it's a supply side shock. But we still think at the end of the day, there'll be a pretty strong incentive for the government to actually increase policy support once there's a credible plan to deal with these restrictions.
What does a stagflation-proof portfolio look like if that's becoming an emerging risk?
So that's a word that comes up in a conversation with our clients, and definitely in the quarter, at the start of this quarter at least, in the fourth quarter at least, we're getting that dynamic a bit. In the long run, we still have faith in the credibility of inflation targeting regimes around the world. So we still think the inflation will moderate, and in fact, the hawkish communication from the Fed will actually add more credibility to that. But in the near term, we'll continue to cope with some volatility in the markets, and both on equities and fixed income markets. So what we're for the stagflation portfolio, the first step is obviously to increase cash levels. And this is what we have done in light of the Fed communication last week. But on the fixed income side, especially on the shorter duration, front, there are very interesting opportunities, especially in Asia high yield and Asia, lower rung of Asia investment grade. So we'll be very opportunistic, and we'll try to kind of take advantage of those opportunities. And for the investors, if you take a view that Chinese economy will eventually stabilize, the Asian economies will eventually stabilize, the region offers a lot of opportunities. So that's what we're focusing on right now.